Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for, let's just call it the end of July, for July 31st, 2022. I hope you guys and gals are having a great summer. It's obviously been a volatile one in the FX market, in all markets actually, as interest rate expectations continue to flounder all over the place. And that creates a lot of volatility for us as traders, which is a great thing. And I know you and I are excited to see that. We have a busy week this next week with a lot of key data coming out, and really a lot of key levels are being tested as we speak. So let's go ahead and get into it. I'm going to take us over to the Forex Analytics dashboard. Let me move this data flash. That, by the way, comes with Forex Analytics. All your analysis can be found here in the platform if you want. You can go, to basic technical analysis, harmonic, Elliott wave, candlestick analysis, macro analysis. You can see, news from Live Squawk, so on and so forth. But I'm actually going to take you over to the live chart so I can do a little bit of drawing for you. And I'm going to actually start off today with cryptos. And the reason why I'm doing that is because we're at such a key inflection point, in my opinion, with the markets that we have to start paying very close attention to high beta risk indicators. And one of them, and probably one of the best ones, is going to be the crypto market. Many of you have obviously been involved in the crypto market, and you've traded Bitcoin, Ethereum. Many of you have traded some of the altcoins. Those have been hit obviously really hard over the course of the last year, as we've seen a lot of them, lose 80–90% of their value. But when you're talking about Bitcoin, Ethereum, and some of the other mainstays, their pullbacks have been pretty good, but have been major, but maybe not as bad as some other of the crypto markets. But we are at a pretty key inflection point when you talk about Ethereum and Bitcoin. And I want to talk a little bit about this, because I think if we want to know if stocks are going to continue higher, we have to start watching some of these high beta crypto names. So let's talk a few things out. And most of you already know this analysis if you listen to us on the daily F.A.C.E shows, which are free shows, by the way. I'll just show you where you can get them. First of all, you can get the link right at the bottom of the YouTube channel, right in the description if you want there. But also, if you're on our website on forexanalytics.com, we have the Flow show, which is a European show that prepares you for the European trading day, and then we have this F.A.C.E show, which prepares you for the North American trading day. They both are free, so please take a look at those when you get a chance. Like I said, if you're a constant at those daily free shows, then our views here on cryptos. Bitcoin, is approaching some pretty key resistance, and that key resistance is going to be around the 25.5 level. That's the previous support right here. We've held the 20,000 level, which is a key breakout point from the last cycle high back in the end of 2017. Obviously, everybody's been looking at that. We traded a little bit below it towards 17K. We bounced back, consolidated around 20K, and now it looks like we're consolidating and making a move higher. I would think that the risks are at this point that Bitcoin reaches for 25.5, maybe as high as 27, 28,000. That previous support, you can see this really major support. Whoops, let me just take this dotted line here. You can kind of see it. I'll just move it a little. That's going to be really key resistance on the way back up. So 27, 28, maybe even 29,000, maybe even as high as a 30K level. But if that continues to reach higher, then we know that people are taking on risk. Therefore, they're buying stocks. They're probably selling dollars. And how bonds react is questionable. So we'll see about that here in a moment. But Ethereum has actually been outperforming Bitcoin. A lot of that has to do with the merge, and that's a big talk of the town in the crypto markets. I'm not a crypto expert, but I have obviously seen that Ethereum has been outpacing Bitcoin, and we could extend gains further. I wouldn't be surprised if Ethereum makes it back towards the 20,000, maybe even 20,000. I'm sorry, 2,100, maybe 2,000 level before we see a resumption of trend lower. And that by the time we get there, you would think that the 200-day moving average would be coming into view, and that's right there. In case you can't see it. So let me go ahead and Let me get rid of that for a second. Let me get rid of that. All right, so let's take a look at something else before we get into the equity markets. Last week, if you were on the week ahead video, we talked about the major lows that were being forged in precious metals. Gold has obviously rallied substantially since then. Silver also has rallied substantially from the 618 retracement. If you weren't around to capture these gains last week, again, if you go to the week ahead video just 7 days ago, we talked about this major support being held. If you are trying to chase it higher, whether it's gold or silver, I'm not saying that it can't continue higher, but if you're just now buying it right now, you have to imagine it's already moved. Like silver, for example, has already moved 10%. If it's already made a 10% move and you're chasing it, you have to think about that. Your risk reward becomes skewed with more risk than potentially reward at this point in time. So I do think that they have further to go, but how much further? I mean, do they they get back up to 21 dollars with silver? Maybe gold reaches for 1,800, somewhere around there. That means there's probably further pain if you're short. But if you're just establishing new positions, you've got to think a little bit about, hey, am I behind the curve? Am I behind the smart money at this point? Okay. Again, it's purely momentum is moving higher, but just think about, entries and where your risk is moving forward if you're playing the precious metals market. Let's also talk about the S&P. Last week we were discussing, and if you look at this chart that we were talking about last week, we were talking about the S&P rallying to 4,100. That's where, see this black line is? That's what I drew for you guys over the last 2 weeks. Okay, so you can say, okay, well, congratulations, Blake, we've done that. But what do we do from here? And that is a good question. And I'm skeptical about where we're at currently. And it's not because I don't believe in the stock market long term. If you think about it, just think about it, whether you're talking about, yourself, your parents, your grandparents, your great grandparents. Think about where the market was then and think about where it's at now. Do stocks move up to infinity forever? I would venture to guess if you believe in human ingenuity and creativity, it will continue higher forever. But obviously, there's good entry points here and there. So if you're buying the S&P now and you're going to close your eyes for the next 30 years, yeah, you're probably going to be fine. But that doesn't mean that we can't have a several-year consolidation, which I believe that's what we're going to be doing. The analogy I like to give to traders is we just came off of a 12, 13-year party. And we're going to have a hell of a hangover. We're probably going to have a hangover or consolidate for the next few years. So, I'm going to be using these levels to sell into. Whether it's here at 4,200 or maybe it's closer to the 200-day moving average at 4,400, that's to be seen. And I do think that this week we're probably going to be using this current rally that you're seeing in the markets as an opportunity to sell into. So the question is, how far can we go? So let's go ahead and do a little homework here, do a little work and see where those key levels of resistance come in. And what I'm going to show you right now is you're probably going to see some confluence of resistance. Let me get rid of this fib too. We don't need that for right now. You're going to see a confluence of fib levels that we're coming into view that we have to pay very, very close attention to. That's not the one I want. I want this one. Okay, so if you notice, the 50% retracement of the all-time high to the most recent low, right, this year's lows, 50% retracement comes in around 4,200. If you take the last big drop that we've seen, now you might be thinking that's the last big drop, but this one right here, from the end of March, basically to the yearly lows, the 618 retracement or the 618 Fibonacci retracement level comes in around 4,260. So in my view, this week, we could reach for these levels, but I would be very nervous about trying to chase the markets much higher than that. Now, if you think about it from a trading standpoint, if you are a breakout trader, okay, which some of you might be, if you're a breakout trader and you're not looking at anything else that I'm showing you, but you do this. All right, well, if we break, 180, I'm going to actually get long S&P on a breakout. That makes a lot of sense to me from a breakout trader perspective. But what they may not be looking at is some of the fib confluence that's coming just above that. So how many times have you seen a breakout fail? It happens all the time. So if you get a breakout above the 4180 level and you trade towards 4200, 4230, 4250, you might use that as an opportunity, and I'm going to draw this for you so we can take a look at it. What happens next week or in the next 2 weeks is that you get a reversal once you reach that confluence of resistance. And that's how I'm going to be approaching the market next week. Now, what could turn the market? And don't worry, guys, I'm going to get in the FX market in just a minute. What could turn the market this next week? Well, there's a lot of things. Most of the things that are coming out that we need to start paying attention to are the employment data. Obviously, data matters. We've been harking on this all year that data is going to start to matter, because once interest rates start moving, expectations will shift based on what economic data is doing, whether it's underperforming or outperforming, right? So obviously, employment data is that what everybody cites is the last domino to fall, the lagging indicator. So with Canadian and U.S. employment data this week, we're going to have ADP data. We're going to have ISM services data that comes out on Wednesday. All in ISM manufacturing that actually comes out on Monday. All of this is going to feed into, is the stock market going to continue to rally, or is it going to turn around? Now, keep in mind, good data is bad for stocks. Bad data is good for stocks. Did I just say that opposite? Let me rephrase that. I'm sorry. Let me just say that again. Bad data is good for stocks, okay? Good data is bad for stocks. So many economists and traders and market participants and FinTwit people and everybody else, everybody is predicting that our employment is really going to start to weaken this month. How about if it doesn't? How about if the U.S. economy is more resilient than the market believes? That wouldn't be a surprise, would it? I mean, wouldn't be the first time that the U.S. economy has outperformed economists and analysts' expectations. Well, if you're thinking about it from a technical perspective and what the S&P is doing, and remember, I'm just talking about the S&P. We could do the same analysis on the NASDAQ or the Dow, which we had so many Dow components report last week, earnings. We can talk about that on the free F.A.C.E show if you want to. Just ping me and we'll look at that live. That's one nice thing about being live with myself and the rest of the team is you can ask questions and we'll be able to address them for you. But if you think about towards the end of next week, if we start seeing that the economic data, or let me take that back, if the employment data is not as weak as the market is expecting, could we see strong data weaken stocks at the end of the week? I think it's entirely possible, and I think that is something that we need to pay attention to. All right. Now, once again, the stock market is very fluid right now, and we're going to cue off of what's happening in the crypto market, and we're going to keep a real close eye on precious metals going into next week. Now, before I get into the currency market, which I know the dollar is the driver of markets, and what's happening in FX matters. It doesn't matter what market you're trading. You really should be paying attention to the dollar because that's where all the biggest money is flowing. It's the biggest market out there. But before I get into that, I need to mention the Trader Funding Program. This is our sponsor for today's show. If you have not taken a look at the Trader Funding Program, you should. I was just having a conversation. I had almost a half an hour, or actually it was more than a half an hour conversation with a gentleman that actually listens to this show every day or every week and has been for years. By the way, if you're listening, what's up, man? We had a Skype conversation face to face. Well, he saw me on video. Anyway, we were talking and about the Trader Funding Program because he's going to get involved with the Trader Funding Program. But he raised a really good point that I think needs to be talked to about you with you guys and gals. First of all, yes, it's great. You can access larger amounts of money. You have to take an assessment. If you pass the assessment, you get to keep 75% of the gains, and you take none of the losses, and we keep 25% of the gains. But what was really important, and one of the key components that he brought up is, what's important to him is that he's, there's two things. There's no timeline, so we don't force you into making bad trades. You trade at your own pace, which is awesome. You can take as much time as you want to go through the trader funding program, but you also get the support. Now, this is for a limited time, but you get the support of the Forex analytics community. So you have ideas, you have other traders to share ideas with, ask questions to, look at what they're trading, getting different ideas in the market. And that's the most important thing, because if we just, drop this load on you for you to like, hey, go ahead and, try to pass and make money. Good luck. That's difficult for a lot of people, but giving people a community and a place to go to, that's really important. So make sure you take advantage of that with the trader funding program, and check us out. And you can watch the video at the very bottom of the trader funding program website, and it's a 2-minute explainer video. You can see me there, and it's easy. So watch that. All right, back to analysis. Let's talk about currencies, and let's go back into the dollar. So the dollar is at I'm going to say is a very key inflection point. If you remember last week's title to the week ahead video was, is a dollar top in? That was the title from last week. I think it is near term. And now, though, we are at an inflection point. And if you're out there shorting dollars, you have to be very careful. And I'm going to tell you, me personally, I happen to be short dollars. But I am also being very careful at these levels because for a few reasons. Well, first of all, we're at previous resistance, which is current support. We're at a 618 Fibonacci retracement of the last major leg higher. Okay, so that's 2. 3, we're at channel support. You might draw your channel slightly different than me, but we're basically at channel support here, roughly. There are 3 things that almost works with: horseshoes, hand grenades, and technical analysis. It's almost a channel. Okay, good. That might work. But just keeping that in mind, that we're at pretty key support with the dollar index, you have to then flip over and say, well, how bullish am I in the euro? Because the euro makes up over 50% of the dollar index. And I'm going to tell you, frankly, I'm not very bullish the euro. That doesn't mean the euro can't go up. But there's a lot of things that actually have to fall into place for the euro to rally from here. There's a lot of impending. We are going into the tail end of of 2022 and the winter months, and Russia has control over European gas pipelines, a lot of it. That is obviously a problem for the eurozone. High inflation and slower growth. That's another problem for the eurozone, especially when you have such fragmented countries as the eurozone. Now you got the likes of Italy versus the likes of Germany, and everywhere in between, right? So France and Portugal and Greece and you name it. It's all over the place. So Europe's got its own basket of issues. So it is hard for me to be from a fundamental standpoint, like very bullish the euro. Technically, it's not making lower lows. That's a good thing. But we do have to scale back above 104 before I turn bullish the euro and bearish the dollar index as a whole. So let me say that again. So the euro has to get it back above 104, which would be this trend line. And close as like a hand grenade. It could be 103.75. It could be 103.50. It's somewhere around here, right? We have to get somewhere around there and get above it for the euro to become bullish. And once that happens, I'll feel really confident about saying, hey, I think a longer term top is in the dollar. But right now, it's a little iffy. But there is something else that's happening here in the currency market that I think is really important. First of all, the dollar yen has just slipped down to support. We drew this last week. Channel support. Here we are, 50% retracement of the last move up. Good. Now it's at really big support. But the dollar yen's going down because yields are moving lower. So if you look at like the 10-year yield, we have this, and I know I actually in last week's notes, go to last week's week ahead video. I'll read it. Yields may be developing a head and shoulder pattern as well. That was the notes from last week's week ahead video. So what does that mean? Well, we have this shoulder, head, shoulder. The target, basically roughly just, takes us back down to 2%. Let's just say roughly around 2% in the 10-year yield. Now, typically speaking, when you see a move down in yields like that, it's going to influence the dollar yen. And if the dollar yen breaks down, that doesn't mean the dollar as a whole is going to break down, but it will impact the dollar index, because the yen is not quite 20% of the dollar composite genetics, if you will, but it is a pretty substantial part. So if you see a move lower in the dollar yen, could it influence the dollar index? It could, and that's something that we have to pay attention to. A couple last things I want to mention before I let you go, and I hope you guys and gals are enjoying this this video that we do for you here at Forex Analytics. If you do, please do 3 things. Okay, give us a thumbs up if you're watching us on YouTube. That makes myself feel better. It makes me feel good. It makes our team feel really good. Jump in the comments too. If you have any comments about anything that I've mentioned, please comment, and I'm going to try to comment back to you. That's a good way for you to comment to me. Thumbs up, comment, and subscribe to the channel so you don't miss any of our content. And you know what? I'm going to ask for one more thing. If you see us on social media, you saw this video on Twitter, or you saw it on LinkedIn, or you saw it on Facebook, please share it and at least like it, and maybe share it with your followers and your friends. I would appreciate it. So would the Forex Analytics team for putting this together for you over the weekend. Okay, 2 last things that I'm really paying attention to. The sterling. The sterling came out of the descending wedge. It's been a little. It's kind of been struggling a little bit, but we have the Bank of England this week, and here we are at the 50% retracement. Now, I think the people in the UK are going to be better suited to answer this question, but I know there's a lot of people in the UK that do not believe that the Bank of England and Governor Bailey is going to be able to really keep up the pace of rate hikes with the pace of inflation. So it's going to be really interesting to see how the Bank of England on Thursday morning, by the way, early Thursday morning for me anyway, but Thursday morning in Europe, it's going to be really interesting to see what the Bank of England does here, and see how, if they can raise rates by 0.5%. Now, the market expects them to raise rates by 0.5%, but can they become more hawkish? That's really the question. Is there room for disappointment? Absolutely there is, especially if you get, a rate hike and not everybody votes for it. Not all the MPs vote for it. So that would be another issue. Last but not least, I wanted to cover going into this week is we also have the RBA rate decision. I know a lot of you guys and gals have been trading the Australian dollar on the long side with me over the last couple of weeks, and it's been great. I mean, we've had this nice rally. Now we're out of this wedge. We're probing higher. We're closed basically at 70 cents. But in order for us to really make it towards the 78% retracement and the 200-day moving average, I think that's really going to have to come from Monday night, which is actually Tuesday morning if you're in Australia or in Asia. It's going to be the RBA rate decision. So we're going to be watching to see if they're going to continue to raise rates at a 0.5% clip, which surprisingly they have. And I think that's one of the things that's kept the Aussie dollar so well bid despite the sell-off in equities or in risk, is that the Aussie's been holding up because the RBA has been steadily hawkish and persistent in raising rates. So it's questionable to see if they will continue. But I'm old enough to remember a time when the difference between the RBA and the Fed, the difference between the rate differentials was quite substantial in Australia's favor. So, if inflation still is an issue and commodities are still commodities still continue to be in demand. Countries like Australia have no other choice than to continue to raise rates. And, obviously, if you're watching China and the lockdowns in China, that also is going to have a big influence on what happens in Australia, being that, China is Australia's biggest importer of Australian goods. So, guys, gals, remember, we do a free show every single day, 2 of them for you. We help you prepare for your trading day. And it's not just my words. It's the analysis from the rest of the Forex analytics team. So if you haven't jumped over to our free shows, please jump over to our free shows and check us out. It is really the best place to get prepared for your trading day. My name is Blake Morrow. I want to thank you so much for spending your time with us this weekend. Have a great remainder of your weekend. I'll see you Monday morning on the F.A.C.E show. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.